Most people make the Social Security filing decision once without fully understanding what it does to their lifetime income over the following 2 decades. The age at which you file changes your monthly benefit by as much as 76% on the same earnings record. There is a point in retirement where 2 different filing strategies produce exactly the same cumulative lifetime total. Before reaching that point, the person who claimed early has always collected more in total benefits. After it, the person who waited has always collected more, and that advantage grows with each additional month. This simulation finds that crossing point for 3 different filing age combinations and explains what the numbers mean for a decision most people make once and never revisit. Social Security retirement benefits are calculated relative to your full retirement age. For anyone born in 1960 or later, that age is 67. Filing at 62, the earliest eligible age, reduces your monthly benefit to 70% of what you would have received at full retirement age. The reduction is permanent and does not reset or recover once you begin collecting. The reduction accrues at a defined rate. 0.5% applies per month for the first 36 months before full retirement age. 0.5% applies per month beyond that point. Filing at 62 produces a total reduction of 30%. That is 5 full years before the full retirement age of 67. Filing at 70, the latest age at which delayed retirement credits accumulate, raises your monthly benefit to 124% of your full amount. The delayed retirement credit adds 8% per year of delay between full retirement age and 70. 3 years of delay produces a 24% permanent increase. The spread between filing at 62 and filing at 70 on the same underlying earnings record reaches 76% in monthly income. You are not choosing between different amounts of money earned. You are choosing between more smaller checks and fewer larger ones. The break-even age is the moment where those 2 running totals meet. This simulation uses the Social Security Administration's published average benefit at full retirement age for 2024. That figure is $1,907 per month. Reduced to the 62 filing, that becomes $1,335 monthly. Left at full retirement age, it stays at $1,907. Extended to 70 with full delayed credits, it rises to $2,365 per month. The simulation tracks 3 amounts across 3 start dates to find where the lines cross. This simulation holds the annual cost of living adjustment consistent across both filers in each comparison. Both the early and late filer receive the same annual percentage increase applied to their respective base. Because that percentage is applied to a larger base, the late filer gains more in absolute dollars from each annual adjustment. That compounding advantage is not reflected in the break-even calculations below. The break-even ages shown here therefore favor the early filer by a small margin compared to what the COLA-adjusted math would show. The 62 filer starts collecting $1,335 monthly. The 67 filer receives nothing during those 5 years. By the time the 67 filer collects their first payment, the early filer has accumulated $80,100 in total received benefits. That is the lead entering the comparison. Once both are collecting, the monthly gap between the 2 checks is $572. The 67 filer closes the accumulated lead at that rate each month. The lead is $80,100. The monthly gap is $572. Dividing one by the other gives approximately 140 months. That places the break-even at 78 years and 8 months. Before that age, the 62 filer holds the higher lifetime total. After it, the 67 filer has permanently surpassed them. By age 85, the difference between the 2 outcomes reaches approximately $48,000 in favor of the later filer. By age 90, that gap has grown past $80,000 and continues to widen. Now extend the same logic to the maximum delay. The 62 filer has an 8-year head start before the age 70 filer receives their first payment. 8 years of payments at that rate accumulates to $128,000. That is the lead entering the comparison. It is larger than most people expect when they first encounter the numbers. Once both are collecting, the monthly gap is $1,030. That is nearly double the previous comparison. The lead is $128,000. At that rate, closing it takes approximately 124 months. 124 months after age 70 places the break-even at 80 years and 4 months. Below that age, the 62 filer holds the cumulative advantage. Above it, the age 70 filer has surpassed them. The wider monthly gap means the late filer's advantage grows faster after the crossing than in the previous comparison. By age 85, the gap between the two strategies exceeds $70,000 in favor of the person who waited. By 90, it has grown past $140,000. The third comparison has the smallest head start and the smallest monthly gap. The 67 filer collects for 3 full years before the age 70 filer receives anything. 3 years of payments at that rate accumulates to roughly $69,000. Once both are collecting, the monthly advantage for the age 70 filer is $458. Dividing that into the $69,000 lead gives approximately 150 months. 150 months after age 70 places the break-even at 82 years and 6 months. Before that point, the 67 filer holds the higher cumulative total. After it, the person who waited until 70 has pulled ahead permanently. This comparison matters most for people who have already ruled out 62 and are deciding between the full retirement age and the maximum delay. The break-even ages only matter relative to how long you actually live. That is the variable no formula can resolve. The Social Security Administration publishes actuarial life tables each year. For a 62-year-old American man, the period life table places median remaining life expectancy at approximately 78 years. For a 62-year-old American woman, that figure is closer to 81 years. Now place those numbers alongside the break-even points. The 62 versus 67 break-even is 78 years and 8 months. The median male life expectancy falls within months of that line. The median female lands roughly 2 years past it. The 62 versus 70 break-even is 80 years and 4 months. The median male falls about 2 years short. The median female sits close to it. The 67 versus 70 break-even is 82 years and 6 months. Both median figures fall below that point. These alignments are not coincidental. The system was designed with actuarial neutrality as a stated objective. For the participant living near the median lifespan, early and late filing were intended to produce broadly comparable lifetime totals. The break-even math reflects that design. The problem is that the individual is not the median. The distribution of actual lifespans around that average is wide. A shift of 5 years above or below the actuarial median changes the cumulative outcome by $30,000 to $80,000, depending on which comparison you are running. The median is a useful reference point. It is rarely an accurate personal prediction. 3 elements affect the actual dollars in ways the break-even calculation does not capture. Spousal benefits add a dimension the single-person analysis misses entirely. Married individuals can claim a benefit based on their spouse's earnings record if that produces a larger payment than their own. When the higher-earning spouse delays to 70, the spousal benefit available to the lower earner also increases. After the higher earner dies, the surviving spouse receives the larger benefit as their own ongoing income. A decision that appears marginal when analyzed for one life can appear substantially more favorable when its effect on the surviving spouse's income is included across a combined household lifespan. Medicare Part B premium coordination affects net monthly income in a way the gross benefit comparison does not reflect. For retirees who delay Social Security past Medicare eligibility at 65, the Part B premium is billed separately from their Social Security payment rather than deducted automatically. The gross break-even math remains the same, but the cash flow mechanics differ during the gap years. Federal income taxation of Social Security benefits is a third factor. Up to 85% of benefits may be taxable depending on combined income from all sources in retirement. A higher monthly benefit from delayed filing can push more of that benefit into the taxable portion. The net after-tax income difference between filing ages is sometimes narrower than the gross comparison suggests, particularly for retirees with significant income from other sources. Longevity expectation has the greatest effect on which filing age produces the better outcome. If health history and family background suggest outliving the actuarial median by a meaningful margin, the higher monthly base produces substantially more in cumulative total across those additional years. Each month past the break-even adds the full monthly gap to the late filer's advantage. That addition continues indefinitely and grows in absolute terms with each passing year. A married household with a significant earnings gap between spouses changes the analysis in a way that single-person math does not capture. When the higher earning spouse files at 70 and later dies, the surviving spouse inherits that benefit as their own. The decision extends its consequences well past any individual break-even point. For couples where one partner is likely to significantly outlive the other, the age 70 choice for the higher earner can function as survivor income protection for decades beyond the break-even calculation. The absence of financial need between 67 and 70 makes the delay practically costless in immediate terms. If living expenses can be covered without Social Security during those 3 years, each month of delay adds a permanent base increase without requiring you to forego income you actually need. Documented health conditions that shorten expected lifespan move the break-even dates further into the future, as a practical probability. If your expected outcome falls well below the actuarial median, the accumulated lead from early filing is more likely to remain your actual result rather than be overtaken. Immediate financial need removes the comparison from the domain of strategy. If Social Security income is required at 62 to cover essential expenses, the option to delay does not exist in any practical sense. A theoretical advantage you cannot afford to pursue is not an advantage. 3 break-even ages, 3 distinct trade-offs. Filing at 62 versus 67. The break-even is 78 years and 8 months. Filing at 62 versus 70, the break-even is 80 years and 4 months. Filing at 67 versus 70, the break-even is 82 years and 6 months. The Social Security system was built to produce broadly comparable lifetime outcomes at the median lifespan. If you live near that median, the choice of filing age matters less than it might appear on the surface. If you live well past it, the later filing produces a meaningfully better cumulative total. If you fall short of it, the earlier filing accumulates more across your actual lifespan. What the mathematics cannot tell you is where your lifespan falls relative to those medians. What it can tell you is exactly how much is at stake at each of those crossings, and what it takes to move from one side to the other. For a decision most people make once, without running these numbers first, that is the calculation worth doing before anything else. If this simulation helped clarify the Social Security timing decision, CashCinema publishes more calculations like this one each week. Sources for all the data used here are listed in the description below.